All right, welcome to The Explainer. Today we are diving deep into something super important, the secret language of the market. I'm talking about price patterns. We're going to figure out how to spot them, what they're trying to tell us, and most importantly, how you can use them to make smarter trading decisions. Okay, so let's kick things off with, well, a pretty memorable analogy from our source material. I know, it's a bit out there, but honestly, it's kind of perfect. It really captures that feeling of anticipation, right? You can feel the pressure building and you just know a big move is about to happen. So, jokes aside, what are we really talking about here? Think of price patterns as stories. They're these unique shapes that show up on a chart and they're basically telling us the mood of the market. They give us these little clues about where the price might go next. Now, to make sense of all these stories, we're going to break them down into three main categories. You can think of them as the U-turn, the pit stop, and the crossroads. Simple, right? This is going to be our roadmap for today. All right, first up, reversal patterns, the U-turn. And yeah, the name pretty much says it all. These are the patterns that give you a heads up that the trend might be about to completely change direction. You know, if things are going up, this could be a sign they're about to head down. And the other way around, of course. And kicking things off in this category is a real classic, the double top. This is a big one. It's a bearish reversal pattern, and it's basically the market screaming, hey, this rally might be running out of gas. So, what does it look like? It's literally shaped like the letter M. Picture this, the price is climbing, and then bam, it hits a ceiling, a resistance level it just can't push through, so it drops back a bit, gathers itself for another try, and fails again at pretty much the exact same spot. Those two failed pushes, that's your M, that's your double top. And what's the story this M is telling us? Well, it's pretty clear. The buyers, the bulls, they're getting tired. That second time they failed to break higher is a huge signal. It's like the sellers, the bears, are stepping in and saying, nope, not today, power is shifting. Okay, let's move on to another big name reversal pattern, the head and shoulders. Just like the double top, this is another bearish pattern that can be a major warning sign that an uptrend is on its last legs. This one tells a really interesting story about a rally that's just losing its mojo. First, you get a decent peak, that's the left shoulder. Then you get a big strong push to an even higher peak, that's the head. Everyone's feeling good, but then the final push, the right shoulder, it's weaker. It doesn't even make it back up to the head. And see that line connecting the low points between the peaks? That's the neckline, and trust me, it is everything for this pattern. And here's the final nail in the coffin. The pattern isn't really confirmed until the price drops from that second shoulder and smashes right through the neckline. That break, that's your signal. That's the moment the market is telling you the uptrend is probably over. Okay, so not every pattern means a dramatic U-turn. Sometimes the market just needs to take a little break, and that brings us to our second category. Continuation patterns. Think of them as a quick pit stop. Yeah, exactly. These patterns are all about the market just catching its breath. You get this temporary pause, right? Price just kind of moves sideways for a bit, consolidating, before it decides to get back on the road and continue in the same direction it was already heading. And a perfect example of this is the rectangle pattern. It's exactly what it sounds like. The price just bounces back and forth between a clear support and resistance level, and whether it's bullish or bearish just depends on which way the trend was going before it entered the box. What you're seeing here is a pure tug of war. Buyers and sellers are locked in a battle, but nobody's winning yet. They're just stuck in this box. It's total indecision. But eventually, someone's got to win, and when the price breaks out of that box, it usually just keeps going in the direction it came from. Okay, now this is where things get a little tricky, but it's super important. Some patterns can be chameleons. They can mean different things depending on the situation. Take the rising wedge. If you see it in an uptrend, it often signals a bearish reversal is coming. But if you see that same pattern in a downtrend, it's usually just a pause before the price drops even more. See? Context is absolutely key here, which brings us perfectly to our last category. What happens when the market is truly at a crossroads and the direction is anybody's guess? Well, that's where bilateral patterns come in. So, what do you do when a pattern isn't screaming reversal or continuation? What if it's just a total standoff, a real stalemate between the buyers and sellers? Well, that's exactly what bilateral patterns are for. They're basically neutral. They tell you, hey, get ready. A big move is probably on its way. But they don't tell you if it's going up or down. So the game here is patience. You wait for the price to break out of the pattern, and then you jump on board in that direction. And the poster child for a bilateral pattern is the symmetrical triangle. You'll see this one all the time. It's a classic consolidation pattern. This pattern is just so cool. It's like watching the market coil itself up like a spring. You have the price making lower highs, but at the same time, it's making higher lows. It's getting squeezed into this tiny, tight point. It's a perfect balance of power, but you know it can't last. Eventually, all that stored up energy has to go somewhere, and boom, you get a breakout, up or down. Okay, so we've looked at all these shapes. We've learned how to describe them, but that's just theory, right? The real question is, how do we actually use this stuff? How do we take this knowledge and apply it to become better traders? So here's a quick cheat sheet for you. It covers the main patterns we talked about, plus a couple others, like the double bottom, which is just the flip side of the double top, a bullish signal. But look, the most important thing to get from this is that these patterns help you form a hypothesis, an educated guess about what might happen next, and that is what helps you figure out where you might want to get in or out of a trade. But I gotta say this, and it's really, really important. None of this is a guarantee. These patterns are all about probabilities, not certainties. They're amazing tools for sure, and they can help you make way more informed decisions, but they are not, I repeat, not a crystal ball. They should only ever be one piece of your overall trading puzzle. So I'll leave you with this question to think about. When you look at a chart, are you really spotting a meaningful pattern, or are you just seeing shapes in the clouds? Because at the end of the day, great trend analysis isn't just about playing connect the dots. It's about really understanding the why, the market psychology driving those shapes, and using that understanding to build and refine your own way of trading.